I guess we go ahead and get started.
Good morning. I'll go ahead and do our roll call. All right. Make sure we're unmuted. Great. All right. Landon Moore,
Present.
Mark Gardner,
Here.
Stephanie Elliott Williams, David Holly, Karen Savage,
Here.
Mimi Terry, Derek Challenger,
Here.
Gloria Taylor,
Here.
Laura Barisha,
Here.
Gregory Coleman,
Here.
Tom Shanley, John Morrison,
Here.
Brian Birnbaum, Jim Whitney. And who is here?
Present.
Okay. All right. All right. All right, now thank you. Okay.
So we
Someone go on too.
don't have a quorum. We can move on to the OPEB trust benefits.
Good morning.
Good morning.
So already you should have in front of you a statement of OPEB America Bank. So what we have here is nothing, I mean, other than what's consistent with the market nowadays. We don't have anything major. But actually, we have 8.3 million in that fund. And during this time of period, I mean, the gains got washed off this month practically. 265,000 was unrealized loss for month of September, bringing to 232,000 for the whole year. Actually, we have $8.3 million in this bank, and since the inception, the unrealized gain is $1.3 million. So nothing major unless you have any question. Our cost for this fund practically is $7 million, and we have $8.3 million in market value.
Do you have an idea of what the sort of the liability is for this? How that's
So this was you brought on later on. So I believe the fact that we do contribution 1.5 million, it's based on actual report. We should be in track. How much is liability on top of my head? I don't know, but I can give you that answer. I will email you. But we do ADC. Actually determine the contribution based on actual reports and everything, and we're in track.
Does John Hancock do that work for you?
Yes, the actual report. Yes.
Okay. Any other questions on the OPEB trust? Should we go back to the minutes now that Stephanie's here?
Yeah.
So we now have a quorum.
Yes, thank you. Sorry, it's traffic.
So we have minutes from the meetings May 4th this year and August 3rd. Has everyone had a chance to review those? Any comments, questions, corrections?
No, I did not.
Can I have a motion to approve both of the minutes?
I move we approve.
Do we have a second?
Second.
Everybody approve?
Yes.
All right, minutes approved. Moving on to presentation by Greystone. Got Jim Whitney on the video here. Hello. You may be muted, or we don't have audio.
Oh, okay. Just one second. Let's see what's going on. Hi.
Can you hear me?
Yep.
Yes. Okay. Jim, I'm going to get your presentation up, okay?
Perfect. Great to be with you. My partner and colleague, Brian's traveling. So we'll both be there in person at the February 1st, 2024 meeting.
Awesome. Can you see that? Jim?
Perfect.
Okay.
Yep, perfect. So let's move to slide 4 for a moment.
Just 1 second. It's looking like it's. Do one thing. I'm gonna do something different. Okay. Uh-oh. Let's see if I can get it to move. Oh, I see what's going on. Okay. Jim, can you hear me?
Yes.
Okay. Can you see it?
I cannot see the text.
Okay, can you see it or no? You can't see it?
I can't see it, but I can pull up my copy here and walk you through it. It's the same.
Okay.
Can you all see it on your end?
Yes.
Yep, we're on the quarter in review, slide 4.
Okay, that's fine. Perfect. So I'm going to start with a review of the quarter, and then I'll segue into some slides about our current thoughts on the markets, and then we will review the portfolio performance. So, quarter, it was a tough quarter, no question about it. Value stocks outperformed growth, large outperformed small. We'll look at these numbers more closely in just a moment. The Dow Jones Industrial Average fell 2.1, S&P declined 3.3, and the small cap index, the Russell 2000, declined by over 5%. It was the sharp rising rates during the quarter that had the most impact on financial markets, and I'll cover that in some more detail in just a minute. The other significant point is that headline CPI continued to decline. The core CPE, which we've talked about before with this committee, is really the major inflation gauge that the Federal Reserve uses, came in at about 3.9. So continues its downward trajectory, but it's still well above the Fed's 2% target. Fed met yesterday, and Chairman Powell, FOMC decided to not raise rates, so hold at the current base rate. So the big news for the quarter was that the Fed continued with its interest rate hiking campaign. They raised another 25 basis points in July before pausing in September and October, November. So since March of 2022, the Fed has elevated rates 11 times to the current rate of 5.25%. So the yield on the 10-year Treasury closed the quarter at 4.57. The 3-month was at 5.45. Let's move to the next slide and look more closely at U.S. stock indices. This is slide 5. Capital markets overview, U.S. equities. So here we're looking again at S&P 500 indexes to put some of the markets in perspective, down 3.3 at the end of the quarter. Year to date was up 13.1. Russell 2000 growth down 7.3. So any active manager that had a growth bias was hurt by the rising rates that we experienced during the quarter. So that brought down the year-to-date to 5.2. If we move to the next slide, slide 6, we can put this in perspective with global equities. Again, at the top, you see the S&P 500 index down 3.3, and Europe fared even worse, down 5.1. So U.S. down 3s, growth down even more, and Europe down even more than the U.S. Now let's look at bonds. How do they perform in the quarter? Slide 7. And here's where the real disappointment comes in for the quarter, is that when we look at the top index, the Bloomberg U.S. Aggregate Total, which is really a a general measure of the bond market in the United States, that fell 3.2%. And if we look down a little further in this slide, we see the Bloomberg U.S. long government bonds. So these are just high-quality U.S. bonds, but they're very long maturities, 20 and 30 years. They were down 9.4%, so almost double-digit decline in bonds. So the setup for the quarter was tough because it was a dual bear market for the quarter in both equities and fixed income, and we'll look at the impact that had on the portfolio in just a few minutes. So I like this next slide, slide 8, total return for select indices Q3 23, because it breaks down the quarter. We're not just looking at how the quarter ended, we're looking at what happened during the quarter by month. And you can see in July, we were having a pretty good start to the quarter. If you look at all these various indices that are highlighted here, whether it's the FANG index, Russell 2000, NASDAQ, S&P, mid-cap, Dow, all performing relatively strongly in the first month. And then things got much tougher. You can see those numbers turn negative in August and again in September. And to the far right, you see the quarter. All of that rolled up into Q3. So no place to hide really in U.S. equities or fixed income or even global equities for that matter. Looking a little bit more closely at fixed income on the next slide, slide 9. To the far right, you see again that U.S. aggregate index down 3.2% for the quarter, bringing the year-to-date number down at 1.2, and that black blue is the trailing 12. And if I can slide your attention to the left, U.S. high-yield corporate, in sharp contrast to the general bond market. You can see the numbers are pretty positive. Year-to-date up 5.9 and 10.3 trailing 12. And the reason for this is that high-yield bonds are much more sensitive to the strength of the U.S. economy. And that's really what drives them. They have higher coupons, they're much riskier. So when the economy is doing well, these bonds tend to perform well. Whereas the U.S. aggregate is generally going to trade as more of a function of the delta or the change in interest rates. Any questions about the quarter? If not, I'll segue into some thoughts about our outlook. All right, so let's move to slide 11. This is just a summary which I'll walk you through quickly because I really want to get to the slides. So the S&P 500 has been trading in this narrow band between 4,250 and 4,400 for quite some time now. The index closed yesterday at just above the 4237. And it's really been trading in this range based on the outlook for Fed policy. But what's happening is that I think investors are starting to focus on the quality of earnings more so than interest rates. The Fed is signaling by pausing in the last two meetings that they're willing to raise rates further, but the tightening campaign is coming to an end. And they are concerned about the lag effect, the speed and breadth at which they raise rates. It'll take 12 to 18 months before that winds through the real economy. And we're starting to see some evidence of that already. As I said, the most notable shift for the quarter was the last 10 weeks, the rout that took place in long duration treasuries. And we've got some slides to really zero in on this point over a 10-week period. So the 10-year rates have increased more than 1.3%, 130 basis points in a very short time period. That's a pretty severe sell-off relative to what we've experienced in the past. So that brought the 10-year rate to a 16-year high, 4.8%. Some of that was driven by strong GDP growth, which is why high yield, lower quality bonds have done so well. Third quarter GDP was really much stronger than expected. It was a blistering 4.9%. This is after the Fed has raised interest rates in an attempt to slow the economy. And it really was primarily driven by the consumer and consumer expenditures. The consumer went on an incredible spending binge for the quarter. We think that starts to wane. We'll show you some slides in just a minute. But really the big news was this 10-week period where rates rose over 1.3%. Let's look at some slides that go a little bit deeper into our thoughts and what's actually driving the market. So next slide, slide 12. We get a lot of questions and there's a lot of press about the Magnificent Seven. And these are top 7 stocks in the S&P 500 driving most of the performance this year. So those 7 stocks, just to refresh, are Apple, Microsoft, Google, Amazon, Nvidia, Tesla, and Meta. So when we look at the purple line on the left, that is the performance of the Magnificent Seven. And you can see the gap in the performance, how strong that's been relative to even the NASDAQ. The dark blue is the S&P 500, and the green is an equally weighted index of the S&P 500. So the traditional S&P 500 is capitalization weighted, it's share price times number of shares outstanding, so the bigger companies have more of an influence in that index. The equally weighted index is just what the name describes. Every stock has the exact same weight. And that's important because performance dispersion is pretty substantial. So let's look at the right side of slide 12 for a moment. And you can see the S&P 500 index up 11.7, NASDAQ up 26. The S&P 500 equally weighted, so every stock has the same weight in the index. You don't get the bias of the Magnificent Seven, generally flat. Now we're going to isolate just the performance of those 7 stocks I just described. They were up over 60%. So you get a very clear description of what's been driving the market this year. And we much prefer to see the average stock moving up and the index not being driven by a small basket. And we call that the market breadth. And the more stocks that are going up, the better the breadth, the healthier the rally. We get these concentrated rallies. It's certainly not a very strong market environment. And if these 7 stocks start to correct, given their weight in the index, that could pull the overall index down pretty quickly. Earnings, I'm not going to go through that, but you can see for all of these indices, they've been up slightly. Magnificent 7 up 5, but that justify a 61% increase. The real interesting piece is this last year-to-date change in P multiple. So this is just the price that investors are willing to pay for the index. And earnings went up 5. I'll use the 7 as an example. Earnings for those 7 stocks during this time period year-to-date went up 5%. And the multiple, the price investors are willing to pay, went up 44 times. The tech giants, the cloud titans, the chip makers, anything affiliated with artificial intelligence had a very, very strong move in the quarter. That was really the essence of what happened in the third quarter. Let's look at slide 13 for a moment. So we get some questions about, well, if the Fed has raised interest rates so much, why isn't the economy slowing? Why isn't it starting to spill over into corporate profits? So if we look at the left slide for a moment, we're going to look at the consumer. A couple things to take away from this slide are U.S. household debt as a percentage of personal income. That's the dark blue line, the left axis, still pretty healthy. If we look at the effective rate on interest on mortgage debt outstanding, that's the light blue line. And consumers have refinanced so aggressively that the average mortgage rate on existing outstanding mortgages is 3.6%. Current 30-year mortgage rates have recently just breached 8%. And you can get a sense of what's happening in the housing market. Not many people are willing to sell their homes if they have, let's just say they have the average mortgage rate of 3.6% to take on an 8% mortgage. So the housing market is really grinding to a halt, and in large part it's because of the mortgage rate, which is causing a lack of supply. So now let's look at S&P 500 to the right. This is corporate debt. Same thing, S&P total debt to total assets in a very healthy range. But the average coupon on that debt is 4%. So corporations issued a lot of debt a long time ago at these low rates. So the fact that the Fed's raising rates isn't impacting large corporations nearly as much as it is for smaller companies. Next slide suggests that maybe the consumer is running out of gas. Maybe that spending that we saw at a blistering pace in the third quarter starts to wane. So upper left, we're looking at credit card balances. I think the first takeaway is that overall consumer debt pierced $1 trillion for the first time. It's not an insignificant level. And the average interest rates on credit cards are now almost 24%. So any debt on the credit card is going to be exposed to incredibly high interest rates. The average credit card balance now is about $6,000. And that's the highest level it's been since 2008. So maybe the consumer is starting to run out of gas. If we look to the right of that, we see U.S. auto loan delinquencies starting to tick up at about 4%. If we were looking at a slightly different slide, we're looking at subprime auto borrowers, those who have loans outstanding against an auto, not prime. Those have moved up even higher. Those are at about past due for 60 days. And that's probably the highest we've had since the early to mid-90s. So starting to see some cracks, and that's really what the Fed has been focused on. So the next slide, slide 15. Is a slide that we've showed you now for several quarters. And this is really where we're against the consensus on earnings. Let me just review and refresh this slide with you again. So on the left, the very bottom, that is 2022 actual earnings. The line above that, the lighter blue line, that's 2023 estimated earnings, and above that is the 24 estimated earnings for the S&P, and then we've dropped into consensus, market consensus for 2025 as well. So our challenge with this year's market is we just think that and we've said this for the entire year, is that the 2023 numbers have been too high. And we've been right for the most part. You can see that number trailing down since the start of the year. We think ultimately that 2023 number is likely to fall below or pierce 2022's. And once that happens, we think that the market expectations for this year have been properly set. Valuations will probably come in a little bit, and that sets us up for a better 2024. So if we look at the right slide, these are consensus earnings estimates. You can see the dip in earnings in 2023, and you can also see a recovery in first, second quarter of 2024. You know, we would probably argue that these numbers are still a little too high, but directionally, if these numbers are correct, the market tends to reward those higher earnings. Next slide, slide 16, just sort of puts some of this big move in interest rates in perspective. On the left, we're looking at the 10-year yields, and we're going way back 150 years, just because it does provide some history and perspective of where we're at. And that dotted blue line is the long-term median. Now, there's a lot of noise in here, particularly if we look at the peak in March of 1980. You may recall those rates were north of 20%. But the point here is that 4 to 5% 10-year Treasury yields are really not uncommon looking back over time. So they feel high relative to where we've come from, but looking back over time, pretty average. And remember, the Fed was keeping interest rates artificially low coming out of the great financial crisis in 2008, 2009 to help stimulate a really ailing economy. And then on the right, we're just looking at the 3-year change in the 10-year. And this is that rapid spike that I talked about. And you can see relative to other periods in history, this is a pretty aggressive change in rates. Next slide, slide 17. I said we drill a little bit deeper on what happened with Treasuries during the quarter. And all we're simply looking at here on the left is that dark blue line is the 10-year U.S. Treasury rate, which is now 4.73, and the 30-year U.S. Treasury rate, which is at 4.92. And you can see the suddenness of the spike in the quarter. So the question is, well, why did this happen? A couple of reasons. One is rates typically rise when the economy is doing well. I talked about how strong the third quarter was, that 4.9% the GDP growth we saw. But we also have some other issues. We have U.S. deficits, and there's questions about the debt sustainability. The government continues to print money. Fitch, one of the major rating agencies, downgraded the U.S. debt. And I think one of the biggest factors was just Treasury issuance. This $550 billion higher than expectations. So that's a lot of debt for Treasury new issues for the market to digest. Recently, yesterday, the Treasury announced that its borrowing estimates for the fourth quarter will be about $816 billion. So the bond market didn't really flinch with that number. So maybe that suggests that when the 10-year Treasury's trading at around 5%, 4 3/4 to 5%, that's enough to attract investors over time. We're very aware of the fact that the Treasury will have to finance $1.6 trillion of debt over the next 6 months. Excuse me. So let's look at the next slide, on the right side of slide 18. And this shows us where yields are currently for 2, 5, 10, 30. And the takeaway from this slide is that directionally you see these start to drift down by the second quarter of 2024. And this is the Morgan Stanley research view on rates. So we're not getting back to where they were, but what it does indicate or signal is that, unlike what we experienced this quarter, the total rate of return on bonds look pretty attractive to us going into next year. So maybe if we're right on these numbers, we could see maybe low, or perhaps by the end of 2024, low to mid-single-digit returns in fixed income, which would be a nice balance to the portfolio. So I'll stop there. Those are some slides to share with you some of our thoughts about the economy before we dive into the portfolio performance.
Can I ask a question?
Are there any questions?
Oh, it's Mimi. How you doing?
Sure.
I do have one question. Hey. I do have one question. The question is, I've been watching or reading where other nations are banding together to create their own money now, and it's to kind of reduce the value of the U.S. dollar. How does that, I know it's China, I've seen a lot of other countries get on board with this, but the U.S. has kind of remained separate. And I'm like, how is this going to affect us? Because, and maybe this is just not a question that you'll have the answer to, but I'm seeing it steadily happening. And I'm like, okay, if the U.S. doesn't buy into this, which I don't see us doing, what is that value of our dollar when it comes to other countries and purchasing and trading? Because, like, they're trying to devalue our money, but we have all this debt. So I'm just a little, I don't know if you have the answer, but I was just curious if somebody could speak to it.
It's a good question.
Question. So really you're referring to the U.S. being the store of value relative to all other global currencies. It's a great question. We hear about cryptocurrency being a deregulated, non-government influenced substitute for the U.S. dollar. Certainly China has attempted over the years to become the world's currency when we've got the euro. But the fact is that the U.S. dollar is close to a 15-year high value relative to all of those other currencies. And it's because it's still considered the safest store of value in the world. And this is in spite of the fact that we continue to issue more debt, and many of these foreign sovereign countries are buying U.S. debt. So it's a good question, but there's no evidence that the dollar is being replaced by either a cryptocurrency or the euro or Chinese currency or any other currency around the world at this point.
Okay. Thank you.
There, I've seen some of the same articles that is the U.S. dollar sort of in jeopardy of not being sort of the world's reserve currency. But Jim, it sounds like you guys don't think that's changing anytime soon.
We don't. We, like everybody else, are concerned about the level of spending coming out of the government, because the pace and the level of debt is really unsustainable. So debt as a percentage of GDP growth for the U.S. Is unsustainably high, and relative to weaker countries, smaller countries, we're much higher. And we used to think about Greece and Italy and their debt as percentage of GDP. So they're now below the United States. I think this is in part what caused this hiccup in rates during the quarter, was this massive supply of new Treasury issuance. So investors around the world are focused on it. And we're hoping Washington does the right thing and curtails the spending. It's just difficult for them to do, obviously.
I think one other, and please correct me if I'm wrong, sort of the stickiness with the U.S. dollar being the world's reserve currency, that a lot of the sort of international trade is priced in U.S. dollars, and that's continuing. As long as that remains, it's going to help support the U.S. dollar.
Yes, oil being probably the biggest example.
Yeah.
Okay. Thank you.
All right, look, you're all very welcome. Let's move to slide 32. We'll touch upon the portfolio performance for the quarter.
All right, Jim, I have to reload it again. Give me just a second, okay?
Sure, sure. And I think we decided a couple meetings ago not to send hard copies. If you all wanted to do this in a more environmentally friendly way. But if you ever want to switch back to a hard copy book, we'd be delighted to send those.
I'm sorry.
Just let-
We can bring it home. Yeah.
Do you have the full, it's attached to your email?
Yeah, we went through it. I've already met with them and went through the presentation, so it's like, I don't want to take that off again.
Jim, I don't know if you can share it if you already have it open.
So sorry.
I've already done this.
So sorry, what happened?
Hang out with y'all.
It escaped.
Because they're going to do a
You know what?
presentation
And I
on
did
the,
that.
I think
Okay,
14th,
all right,
the
just
council.
1 second. I think
Oh,
I'm gonna have to
really?
minimize.
Yeah, you know they do their annual.
Yeah,
No, sorry.
John Hancock.
So sorry, I'm
If
just
you
gonna have to
lose
go
from
back.
Hancock.
John
Yeah,
Hancock. They all kind of hang out together.
Usually, I've never
Get that.
seen this, oh, except that guy, David, what's his name, David?
This Davenport, David
Davenport.
Rose.
Oh,
But
David
these
Rose.
guys are the retirement board. They come, you know,
All right, let me
Shannon.
just start share screen.
Thomas.
Yeah.
Yeah, Thomas, yeah.
Usually.
It's a big guy, but it's not Thomas.
Yeah,
What's his
he
name?
had the black
What
hair.
slide
Brian.
was it he wanted?
Brian, yeah,
Yeah.
Brian.
32 or something?
Okay,
32.
32.
It's not, what's his name? Old guy, he used to be in council. Always, we're going. What's his name?
Is it David?
No, the guy that always.
Can you see that, Jim?
Perfect.
Like that.
Okay.
Oh,
Yeah.
Battle.
Battle, yeah. He's not
So
anymore.
I said, so they should go pretty fast. He ain't saying somebody can do it for $2.
So you all can see that. So I'll provide you some comments on the slide 32. So it was a tough quarter, as you all know. And if we're looking at the net return after fees, the portfolio was down 3.65%. The index was down a little over 3. So the delta there is about 60 basis points. And I'll go a little bit deeper about what drove that 60 basis points of underperformance.
Bless you.
And then the year-to-date, 5.28% versus 6.83. The inception to date, 6.45 versus 6.79. So let's go a little bit deeper. Move to the next slide for a second. So on slide 33, one of the important things that took place during the quarter, because you saw we had 2 very weak months, is we started to move our portfolio allocations closer to our targets. Really in anticipation, we can't time the markets perfectly, but we think 2024 can be a pretty good year if those earnings estimates start to come in. We had some pretty tough volatility in 2 of the months, so we decided to move the portfolio's equity allocation closer to the target. So you look at equities now, we're at 70%, and our target is 70%. Fixed income, 21.3 versus 22. So generally now we're sitting on our policy benchmark. But if we look a little deeper on the next slide, slide 34, upper left, you can see equities are at 70%, but below the overall allocation, sub-allocation, you can see U.S. SMID, so it's sort of small and medium-sized companies. We still have an overweight of 5.1%. And that certainly didn't help us during the quarter. It's something that we watch pretty closely. Small caps have lagged large caps now by the widest margin in 22 years. So at some point, the Fed will start to take its pressure off Fed policy, maybe even cut rates sometime on the 3rd or 4th quarter of next year. And clearly the dispersion between large and small, it's pretty obvious. Looking at size, the effective interest rate being paid by the largest companies, the barely moved up from the lows, as we just looked at. pre-pandemic, but the rate paid by the smallest companies, mid-sized companies, is probably now the highest level it's been in a decade. So cost of capital has gone up for them, concerns about a recession, but now they're also very, very cheap, almost 2 decades cheap. So we continue with that sub-allocation of 5%. Let's move to slide 36 for a moment. So here, this is the portfolio attribution summary we review with you each quarter. The benchmark returns down 3.05%. The broad allocation was about 3 basis points. And just recall that this is, if we sat exactly on our targets, 70-30 targets every day, this would be 0. And I think the good news is we're pretty close to that for the quarter, given the changes we made. And then the sub-allocation effect is within each of these asset classes, what are our weightings? So we're equally weighted equities, but our equity allocation is different than the benchmark. And as you just saw, we're underweight large cap, we're overweight small to mid, and that detracted about 13 basis points. And then finally, the selection effect. This is, well, how did our managers do for the quarter? And this is we lost 43 basis points in the quarter. This was the biggest detractor for the quarter. And I'll review those managers with you just a minute. So that gets the total gross returns down 3.58. So let me just get into the manager review. I think that's on page 47. So I'm just going to highlight a couple managers for you. You can see at the top the Russell 1000. This is the passive index of growth in line with the index we looked at earlier, down 5.26%. The next manager is Aristotle, which is a value manager, large cap valued. And again, as we looked, value did relatively better. Aristotle performs well for us, down 2.9 versus 3 for the index. Year to date, it's up 5 versus 1.7 for the index, and its inception continues to be very strong. Let's look at the growth index for a minute. We talked about the impact of rising rates, so I want to draw your attention to sort of the middle of the page, Rice Hall James. In Rice Hall James, we had a meeting with the manager. The actual stock selection for Rice Hall James was positive, but the sector positioning was a major contributor to that negative performance. So they were underweight energy and healthcare, and that's really what hurt the performance. But we were pleased to see that the stock selection was positive. And then just drawing your attention to, I think, one of the more difficult spots in the portfolio for the quarter was on the international side. So towards the bottom of the page, I'm going to draw your attention to Harding Loevner and Cap Guardian. So at Harding Loevner International Equities, almost all of the attribution of negative performance there was driven by the manager's tilt towards high-quality growth companies, and that faced meaningful headwinds in the quarter. They were actually country neutral, so again, meeting with the manager, it was just the growth exposure that caused that performance. And Cap Guardian, sort of same thing. They underperformed. Their biggest headwind was style. For international equities, growth underperformed value by 9%. So it was a big dispersion that any of the international managers had a tilt towards growth. We think these will start to course correct. It looks like they may have already started as the pressure comes off interest rates a little bit. So we saw the 10-year hit 5% in October, and that's come in about 20 or 30 basis points. We can just turn to the next slide. I want to draw your attention to one other underperforming manager, and this is
Hey, Jim, can I just
Martin Curry.
ask one quick question? What was going on with
Sure.
what was going on with Vanguard? Is that a active strategy on the prior page?
Let me grab it.
Am I
What's
thought,
the all world?
yeah.
Yeah, good question. So I looked into this because it's an index fund, an ETF, and there is some dispersion for the quarter. And what happens is because it's not a mutual fund, it's an ETF, and when we raise money for distributions, we sell the ETF at some point during the day, as opposed to the market close. And if there's a price movement differential between when the ETF was sold during the day and where the index closed, plus or minus, that's where that variability comes in. What we've experienced over time, though, is that tends to smooth out.
So you think it has to just do with
Because-
timing of the cash flows?
Yes.
Okay.
Yeah. Yeah. And also, when there is a sale to fund distributions, cash does sit in the account for a little bit before it gets distributed. So there could be a little bit of a cash drag there as well. Good question.
Okay.
And then on the top of slide 48, Martin Curry, quarter to date, you can see underperformed. And again, we held calls with Martin Curry. And again, their biggest detractor was growth. A little bit of stock selection. They had exposure to South Korea and India, which were negative for the quarter, but the predominant issue for them was growth. So you can see the sharp rise in rates, the impact it has on growth valuations. Managers tend to focus a little bit more on growth than value, and then the impact that had on the managers. But we're not concerned about it for one quarter.
And
So that's
is the same thing going on with the?
portfolio review.
Is the iShares MSCI emerging markets? Is that passive?
Yes.
And I think that's relatively recent. That you
Yeah, it's
added.
February last year. So to refresh about how we think about allocations between all of the major equity asset classes, whether it's large U.S. Or international or EM, we're always going to have a component of passive. The portfolio is stable and not subject to the variability of active management, but we do want to have some active management to generate the alpha and outperformance over time. It's a philosophy, it's an approach that's worked for us for a very long time. So that's the reason we have the passive piece. I'm going to spend a few minutes on the fixed income. So if you look at the double line and Loomis sales, recall that we repositioned the fixed income, we exited BlackRock, bought Loomis, and so far it's working well for us. Year to date, down 3.44 versus negative 447 for the index. And double lines down 93 basis points versus 226. So they did very well in that sharply rising interest rate environment. So I'll stop there and see if you have any questions about any of the material I've covered, portfolio, performance, allocation, outlook. Any questions I can answer for you?
Jim, are you going to talk about the strategy for the fourth quarter?
Yep, the couple things that we're focused on would be primarily the duration and the fixed income. So we'll be meeting with Loomis Sales. We want to understand what that duration is, what they're thinking about for the fourth quarter. More importantly, given our forecast for rates for next year, if we're right, we want to capture that outperformance as the steam in interest rates start to come off. And then in terms of equities, it's difficult to know when the earnings correction that we talked about will actually manifest. We're starting to see that this quarter. Earnings are a little bit weaker than expected, particularly if you strip out those Magnificent Seven stocks. But it could take another quarter or two for those earnings because of the lag effect of the Fed tightening. So it could be Q1, Q2. So from an equity performance forecast, the S&P 500, we think there could be some noise between now and mid next year. But we don't necessarily think we're going to make much money between now and then. The index, this trading range I talked about at the start of my comments, is probably still going to be in effect for most of the first and second quarter of next year. So again, we need the earnings expectations to reset. We need inflation to continue to trend towards the Fed's target of 2%. We saw those third and fourth quarter earnings start to rise in 2024. Those are consensus numbers. So if we get all that, the back half of 2024 could be a resumption of a bull market for us. But I acknowledge it's been tough sledding. There's no question about it. The pressure that the Federal Reserve raising interest rates as aggressively as they have, it just creates tremendous pressure for global financial assets, particularly the United States, as we saw this quarter. Bear market, a really bear market quarter for both bonds and stocks. And most of it is driven by Fed policy.
Yeah, that's it's been a rough 2 years. And from what you're saying, it's potentially we got another 6 months before we, move to better times.
I wish it was sooner. We'd love to get back to growing and compounding the portfolio value. But as you know, the portfolio is structured for the long term. If there's any silver lining, it's that the income that the fixed income part of the portfolio is earning has dramatically improved. It wasn't that long ago where short-term interest rates were sub 1%. If we look at the yields in the fixed income portfolio allocations that we have now, those are somewhere between 5 and 6%. And it's hard. So that's really great news. So that generates a lot more income than we ever thought would be available. And we didn't have access to these rates for 15 years. So now we have access, portfolios benefiting, maybe not on a total return basis yet, but once the pressure comes off interest rates, that higher income will certainly benefit the portfolio, and we might even get some price appreciation from that part of the portfolio. But it's to be realistic, we have inflation still, call it 4.5%, depending upon what index you're tracking, and we have a Fed stated target of 2%. So great progress has been made, particularly if you look back over the last 12 months. But in the last 4 or 5 months, it seems to be stuck in this 4% range. So we've got to continue to get that trajectory towards the 2% earnings reset. And then we think we can have very, very healthy capital markets going forward.
Only other question, just the long-term strategy. Is there any reason that you think that 70-30 is no longer appropriate? Is, from what you've seen, are we still sort of in line with how other municipalities are allocating for these types of liabilities?
It's a really good question. There's a lot of debate about the 60-40 portfolio allocation or the 70-30 allocation, whether it's broken because you have quarters like the one we just experienced where you didn't really benefit from the diversification. We've lost money in both bonds and stocks. Our view is it would not be the right time to make an allocation change. Certainly, it's something we review, we take seriously. We look at all of the facts, the money coming out of the portfolio, the contributions the city makes to the portfolio, and we got to make sure we're balancing the current income, which I just spoke about, and also making sure that we're providing some good long-term growth opportunities for the portfolio to make future benefit payments. So, for the moment, we still think the 70-30 allocation is appropriate. And to answer the second part of your question, no, we haven't seen any of our other clients have any kind of material shifts to their allocations.
Any other questions for Greystone?
Nope.
All right, thanks, Jim.
Always a pleasure.
Looking forward to 2024. Hopefully, better returns ahead.
Can't get there fast enough.
So they're doing a presentation on the 14th to City Council. I don't know if y'all discussed that, even though I was late.
Of November?
To council, yeah. It'll be kind of, we're going to start our council meeting at 4 o'clock, but they'll be, I expect them around 5 to begin presenting. We just have a busy schedule that day, so we're going to start early, but they're going to give their regular update. It pretty it shouldn't be too bad because we've had some change in council. And so it's their usual November update to where we are.
Is that going to include the actuary study too?
Yeah.
Yes.
I mean, I'd be happy to review the materials, or if y'all think it makes sense for me to be there, I can. But
Yeah, I didn't want to.
or maybe I can.
Yeah, I know. I know.
It's
I
only,
didn't want
it's 2 weeks. I guess 2 weeks from yesterday
Yeah.
or Monday, or wait, Tuesday. 2 weeks from Tuesday.
It's hard to keep it up with all this stuff. But I'll give you the date. And, I know we were just trying to do a little different. I know you have a lot to do, and I didn't want to pull you from whatever your job was, but we can look at your schedule and see if you can be there. But it's the regular update. So just kind of introduce them and let them go and say what they say, and hopefully it won't be the same.
Okay. Well, y'all can we can circle back on that and
Okay.
via email or whatever.
Yeah.
All right. Should we move?
Fran, we're happy to. We'll send you the material so you get a chance to review and comment. We've had a couple meetings, so we'll get that to you.
Okay.
It's Tuesday the 4th.
Well, thanks again. I think we can move on to John Hancock.
All right.
Great, thank you.
Sorry, we're gonna get that.
And do it
Okay.
at the bottom. I think it's at the bottom, Stacy.
Yeah, and
At the end.
maybe he wants to stay.
Are you staying?
Jim, did you want to stay?
I'll stay on. Yep.
Okay.
Okay.
So sorry.
All right. The actuarial review.
I have a clicker here, which is dangerous.
We're gonna get there. This is like, oh, come on.
I hope the answer is the liabilities are unexpectedly lower than you thought.
That is not the answer, unfortunately. I can say they are expectedly as expected, so that's,
It's almost
you
right.
know, it's, I don't have any,
I guess it doesn't change much when everybody's retiree already.
right, there's a lot
Payments
less
are
variability
set.
there, right? You have a fixed stream of payments, and there's not a whole lot, generally speaking, that's going to drive gains and losses. You know, if you have an active plan, as people come and go, or they terminate earlier or later, that can drive some gains and losses. But mostly your liability is inactive, and that jinx myself here, but tends to be a little bit more predictable and steady in that regard.
Yeah.
I know, right, we were getting there. Okay, yeah, okay.
Self-serve.
All right,
All
so-
that's making it so it
All right.
minimizes every time.
All right. Okay, all right, let's see. Say sorry. We're gonna get there. Just share. And then, let's see, that'll be this one here. And I hope I got it. Hope so. All right,
Good job.
All right, we'll see if this works. Okay,
all right, is it clicking? Let me know if it's
let's
working.
go for it. All right. So certainly as I go through this, if I'm too fast, too slow, please jump in and make sure you all are keeping me honest and I'm answering all the questions. The other thing I'll say is I've kept this identical to everything that was presented last year. So this is, I'll go over the combined systems, but the appendix does have information separately for fire and police in the supplemental system, although generally the commentary holds true for both plans. So it's a little bit more concise to cover everything together, and then you all have the appendix if you want to see the numbers for each of the two programs. So I'd like to start off with an overview of the systems, just a reminder of what's covered and what these represent. So the fire and police is effective 1/1/1957. It's been frozen for it's about 30 years now. So that means you have no new active participants entering the system. So that's what Landon was saying a minute ago. That's the reason you have a primarily inactive population, because none of your current hires are coming into the system. And then similar story on the supplemental system. It's been frozen for about 40 years. So that's one of the reasons the systems look very similar, is no new active participants are coming in. The benefits are paid out generally under 3 circumstances. So as participants retire, or if they become disabled or deceased, that's when you will start to see payments from the plan. The fire and police system allows retirement at the earlier of either 20 years of service or age 50 with 5 years of service. The benefit itself is a tiered structure. As you can see in the middle there, it's based on the final average compensation of the participants, so that's their 36-month average compensation. For the first 20 years, they earn 3% of that final average compensation per year of service, 2% over the next 5, and then 1% from years 25 on. Participants that retire prior to age 65, in addition to that retirement benefit, will receive an additional $200 a month until they reach age 65. Supplemental is structured somewhat similarly, payouts at 50 and 5. Rather than having that tiered structure, it's a flat 2% of the final average compensation times years of service. And they similarly have the $200 monthly supplement until age 65 for the participants that retire prior to 65. Before we get into results, just go through a quick couple of definitions for you for some of the terms that we're using. The actuarial value of assets it's a smooth value of assets on the market value. So gains and losses over the 5-year period are smoothed, and that impacts the calculation of the annual contribution that we'll discuss. Part of this is to limit the volatility. So obviously, the markets and market value of assets can fluctuate wildly year over year. And the purpose of the actual of assets is to smooth some of that and to give you a little bit more predictable pattern of contributions. Makes budgeting a little bit easier. The actuarial liability is the single present value of that stream of payments. So your plan is primarily retirees at this point. They're collecting benefits. You're paying those out now and into the future, 30, 40 years into the future. The accrued liability is the value of that stream of payments discounted at your rate of return, which is 7.25% to today's dollars, or today's, a single sum. And it represents the fact that, you have earnings on those assets, that you're not paying out all the payouts immediately, the long-term nature of the plan that Jim referenced. The unfunded actuarial liability is just the gap between the liability and the assets. And you can express that as a dollar gap, or we show the funded status. So that's a ratio of assets over liability. And then that all comes together for the actuarial determined contribution. This generally consists of two pieces. The first is your normal contribution. So that is the cost of benefits that are accrued during the year. It's the value of those benefits. For these plans, that is pretty immaterial to your overall contribution. The benefits that the existing members are earning relative to what's paid out are very small. So the larger portion of the actuarial determined contribution is this accrued liability contribution. It's the amortization of your unfunded liability. Notes here, back to 2007, I think there was a decision made that you were going to amortize that payment over 30 years and then incrementally decrease that. So now we're at a 13-year amortization for those payments. So the unfunded liability, you assume, is going to amortize over 13 years, somewhat like a mortgage payment, and that makes up the majority of your actuarial determined contribution. I mentioned the discount rate of 7.25. That's the value that those future payments are discounted back at. The other key assumption is the mortality table. This is consistent with what corporate plans are using, and it's just it impacts the stream of payments that we'll see in the future. Questions or comments on those terms? I live in this world, so I want to make sure that this makes sense for all of you.
Is it an industry-specific mortality table?
It's the same table that the corporate, so the IRS mandates that corporate plans use for their funding. I don't think there's an industry specific necessarily for the public pension plans. My understanding is that this was looked at a few years ago, and it was decided this is possibly maybe a little bit more conservative mortality table for your group. And so, maybe it gives you a slightly more conservative contribution and just a little bit of a buffer, if you will, for bad experience. It's a pretty standard table, and it is updated annually.
I was just thinking like fire and police mortality is probably higher than the general population.
Potentially, although we looked.
But maybe I'm wrong.
In recent experience, you're getting slight mortality losses, but nothing significant. So that's something we keep.
Because you compare the actual sort of experience to.
Correct. So we review that on an annual basis. At least for the past 2 years, I can remember that, relatively small gains and losses. If you get to a point where you're seeing significant gains or significant losses on the liability, then that's a pretty good indication that, okay, maybe we should revisit this mortality discussion. One other note, you're talking about maybe fire and police with slightly higher mortality. There was a more comprehensive update to the IRS schedule for 2024, so the table that will be there for next year. A lot of technical stuff I'll spare you from, but the general picture is that it should see a slight decrease. I mean, nothing significant, maybe 1-ish%, maybe a little lower in liability, but it is, the COVID years are starting to come into play in some of this, and so they're starting to kind of draw back some of the improvement that would have otherwise been projected. So that will be a slight gain on liabilities that you might see next year. Okay, yeah. So one of the key building blocks of any evaluation are the data and the participants. I mentioned your plan is largely in pay, so people that are already receiving benefits, and you can see here that that's the vast majority of your liability is for those participants. We're down to 8 active participants. I believe that's 1 in fire and police and 7 in supplemental. So the growth in liability for additional benefits is not there, and really the bulk of this are those in-pay participants. What that does mean, as we see here, is your benefit payouts are pretty substantial for the plan. They're 30 million or so, coming down to about 28 now. So this is it's showing the net cash flow in the plan over the 5-year period. The 2023 is the new period here. You made contributions for the year of about 8 million in total, paid out about 28 million. A good investment year, so this was above the expected 7.25%. And you can see that even with the higher expected return, you still have a negative net cash flow. That's not indicating that, that's not necessarily a bad thing, I guess is what I want to say. With the payouts of your plan, you're not necessarily expecting to see positive cash flows. You're not necessarily trying to grow the assets. The hope here is between the contributions and the investment return that and I'll try to say this properly, the drop in assets is less than the drop that you see in liabilities. So you have the gap in your funded status. You're not necessarily making that up with additional cash flow, but the way you make that up is the liabilities are going to shrink smaller than the assets. So the negative net cash flow is not necessarily a concern, and when we get to the projections, it's more or less expected at that 7.25%. So I mentioned the difference between the market value and the actuarial value of assets, and I think this picture does a great job of showing market value can go up and down pretty significantly. With the actuarial value of assets, you're smoothing those gains and losses in over a 5-year period. So you will see some fluctuation, but the goal of the smoothing is to give a little bit more, slightly more level, slightly more predictable value of the actuarial value. The actuarial value of assets year over year. When we look at the funded status of the system, that for lack of the predictability, I guess, kind of plays out here. So, had a couple interesting years of 2021 was a strong return, 2022 was obviously a down year, but your funded status has remained relatively stable on an AVA basis. So that smoothing of assets is doing what we want it to do. I have a slide in a little bit that will show the funded status on the market value, and that obviously is more connected. There's more variability in that with the swings in the market value of assets. Questions, comments as I'm going through this? I will keep going. This shows the unfunded liability, similar to what we see on the prior slide, has been relatively stable over the past couple of years, despite some of the changes in the market conditions. So here's that funded status reconciliation I was referencing for the market value. So at June 30, 2022, we look at the value of assets, approximately 200 million, liabilities approximately 290 million. So that deficit, the difference between the assets and liabilities, is about 93 million for a funded status of about 68%. As we go down the line items here, interest cost represents the expected growth in the liabilities. We talked about the liability measures of present value of benefits. The interest cost represents that you're moving out, essentially you're 1 year closer to paying out those future payments, so that you lose a year of that interest discounting. So that's going to increase your liability about 20 million. The benefit accruals from actives, they're not zero, but for rounding, they essentially are zero, right? So you have those 8 members are earning some additional benefits, but relative to the size of the plan, it doesn't really show up here. The payments that you're making to the retirees are going to reduce both assets and liabilities. I'll jump ahead on the liability side. So this is what I was explaining. So your net change in your liability, it grows by roughly 20 million a year. It's going to decrease by about, let's call it 28 a year. So you expect to see roughly about an 8 million drop in liability. the liability gain loss there represents, we do a evaluation on an annual basis. So that represents when we looked at the data as of June 30th, 2023, we had a slight liability loss, but relative to the size of the plan, very, very small. And so your liabilities are dropping. So that's what I was saying, just because you have a negative net cash flow, you're still going to see, and if that negative is small enough, that improvement in the funded status. So going back to the market value, you have the benefit payments to retirees, contributions coming in from the city, that's the actual determined contribution that's been made, the positive investment return, and then the fees that are payable to John Hancock and Greystone. So at June 30, 2023, the market value of assets, 195 million, liabilities, about 282, and we do see an improvement in the funded status from 2022 to 2023 of about a little bit of 1% improvement. Jim talked about the tough quarter, so that's shown out here. I won't go through this line by line, but it's the same concept, same exhibit. The investment return is negative, so you do see a slight drop in that funded status. But if we go back to 2022, it's still relatively steady from where you were about a year and a half ago at this time. Okay.
I have a question.
Yes, ma'am.
The previous tab, the one shows, go to the other one. Yeah. Here, investment return is 18.5, and the next one is minus 0.3. It's too drastic to say one plan has this gain and the other one has lost. Investment and return, you know what I'm talking about?
So this is.
Do you see here, investment return?
Yeah, so this is for
18.5 million.
the combined plan over the prior calendar year, and then this looks at the combined plan for the quarter, so from June 30, 2023 to 9/30.
So you think we'll make the 18.2 million?
The 18 point is what was earned from 2022 to 2023 for the combined plan. So both of these exhibits are the supplemental and fire and police combined. This is showing you the annual period ending 6/30/2023, and then this gets us from 6/30/2023 to where we are at.
And you consider data up to what? You consider data up to what, December or?
This is through September 30th.
September 30th?
Yes, so that's that
Because
quarter
this-
that
yeah,
Jim
quarter.
was reporting on.
Because this year was, we kind of have lost. That's why I was wondering, why is it investment return positive?
Yeah, so this spans.
That's fine, it's
yeah,
not actual, but I'm just saying.
The fiscal year looks pretty good.
Yeah,
Right,
that's what I was
right, yeah,
wondering,
so
yeah.
you
The calendar
kind of-
year, not so much.
First quarter is
Correct.
always a little hit for anything you do.
Yeah, I mean,
Just good.
was it 9/30/2022 when this was shared last year? The funded percentage was 62%. So even with a slightly down quarter, we're still up over right around 5% from where we were a year ago at this time. We have a history of the funded status. This was probably a little bit more interesting last year. So 2012 is the year that dropped off this year. That was the year before I'm going to say this term on the municipal bond. Is that right? So in 2012, you were funded about 30%. You issued the bond that dramatically improved the funded status of the plan. And you can see, relatively stable over the past 10-year period. Some dips and rises there. But you've stayed relatively stable around the mid 70%.
Yeah.
Here's a look at the annual contributions to the system over the past, actual contributions for the past 2 years, and then what we are forecasting or recommending for 2023. In 2021, you put in just a little bit under 11 million, so slightly above the actuarial determined contribution. Last year, the actual determined contribution was the 7.9 million, and we see a slight increase in the recommendation for 2023 to about 8.4 million. And again, this is combined between the two systems. That 8.4 is very much in line with the projections from last year. So the return over the year was about 10%, so it was a positive year, but relatively consistent with the assumed 7.25. So these projections are very much in line, is what I'm getting at, with what you would have seen last year. So we're forecasting slight, maybe not slight, we're forecasting increases in the actuarial determined contribution over the next 4 to 5 year period, and then that's going to level out at about 11 million relatively until the end of that 13-year period where the unfunded is amortized. That's going to ultimately is going to drive the increase in the funded status. The drop that you're seeing in the funded status here, I'll go ahead and explain that. This is related to the asset loss for 2022. So this is this projection, and the funded status is shown based on the actuarial value of assets. So the 2022 loss is, you're incrementally recognizing that. And that's what you see here in the drop, is as that gets more and more of that loss gets recognized, that's what's causing the funded status to drop a little from the current 74%. You're expected to go down even if you earn that 725 that we anticipate, as some of those losses are recognized. And then that's also what's driving the increase in contribution. So that the AVAs smooth things out, but ultimately you still will need to recognize the losses that you're seeing. So that's what happens with the drop in the funded status, and then the increase in contributions is going to drive that back up. And if we were to project this out even longer, you would see that funded status would increase even further.
Mm-hmm.
So, John, in my understanding, in 2026, the increase in the unfunded liability to 81 million is the smoothing out process. Is that what you're saying?
Correct. As we had a pretty large loss in 2022. That's not fully recognized in the ABA. So that's going to incrementally come in. It's a 5-year smoothing period. So the 2026 is the last year where that loss,
okay,
that smoothing kind of appears, and it gets, or I think actually 2025. So it's like fully recognized by that point. So that's why there's a slight dip in the funded status as that works its way through the system, if you will.
So as that smoothing period, we'll just call it that, but our contribution increases what the city actually pays into the fund,
yes,
to keep it level.
Correct, right. So there is,
Yeah.
right, the smoothing is going to defer some of those losses, but ultimately, you'll need to make up for the gap between the expectation and what occurred, and that's what's driving the increase in the contributions. Questions, comments? That's the end of my section. Again, the appendix has additional detail for the two systems if you would like to view those separately, but generally speaking, the commentary holds between the two plans.
I don't have any other questions unless somebody else does.
All right.
Thank you, John.
Thank you.
Appreciate it. Any other questions, comments, concerns before we adjourn? Okay, meeting adjourned.
Thank you.
All right.
Thank you, Jim.